doing, everyone? Welcome to the Stock Market Morning Prep video for Wednesday, May 27th. Hope everybody enjoyed that long weekend here in the States, Memorial Day weekend. A lot of great weather here, a lot of great fun over the weekend, that's for sure. We come back into the markets, and look at what happened. We had a nice big down day, actually a quick flush for the last hour, the first hour of the trading day. Not much to get short if you were looking to get short. Markets just really flushed pretty hard, coming on a stronger than expected number. We had Friday, which we had a holiday, which was surprising, but talking to many traders, I was explaining that I thought that the markets were going to sell off next week, early next week, and I mentioned that on Thursday. Say I'm looking for a little bit of a sell-off. Now, obviously, that was a nice little sell-off we had on volume, no less. And it's one day. So does one day really make a trend to go lower? No, it does not. However, I am probably in the camp of looking for lower prices. You know, you had Janet Yellen speaking, saying regardless of economic data, we're going to be raising rates either way sometime this year. So that's not a good sign for the markets in the short term. And then we had some hot CPI numbers that came out as well. So that all points to the Fed is going to have to move quickly. They're getting behind the curve now. So that's not a good sign. And it's funny how Friday, how the markets are manipulated. The markets didn't go anywhere. What I would expected a deeper flush on Friday, but since we had all the big players gone, that actually did not happen. But what happened on Tuesday? Market sold off early in the morning, rallied back to the high of the pre-market session, and right at 9:30, the market just sold off pretty hard. So not a good sign that the markets are sold off, although believe me when I say that it's healthy for the markets to sell off. I think it's a very good thing. We haven't had a correction in 5 years of anything over 8 to 10%, which is ridiculous, and I think it's way overdue. I think markets need to reprice itself, and we have major red flags going across our markets. And you know, one is the VIX. As you can see, here's the VIX, and you can see we are basically at all-time lows again. I mean, you're talking 11 and change, basing around these areas. And I like to put a Bollinger Band on here on the VIX, but if you look at the VXX, which is an ETF to trade the VIX, you could see how low this is here. And when you break outside the band, you close back in. That's a buy signal for the VXX, a sell signal for the markets. And this is exactly what we had here. And this is something that you need to pay attention to with these indicators, because they will tell you, hey, we are overbought or we're oversold, or the markets are due for some sort of a pullback, okay? So here's the VIX. Now, what I want to do is I want to show you the indexes, and of course, here is the inverse ETF for bonds, right? You want to buy the TBT to short bonds. And I mentioned that we're at the 200-day moving average here many times that look for a pullback, but I think that pullback should be bought, because I do think that bonds are going in a topping process this year. So if we pull back to that 50 or even nicely right up that little gap that we had here, right around 43-ish, I think, and we can base, I think that would be a great little buy entry in the TBT. So bonds go up, right? The bonds yields are rising. That should help equities, because we should have a rotation out of money in bonds, and then again going into equities. That would help put a bid in equities. But let's take a look at the indices now and see where we're at here. Here's the XLF, which is banks and financials. We had a false breakout yet again, and now we're back into this area here, which we're just kind of back testing this little range here, which is fine. You know, it's not a bad thing. Remember, the banks have actually rallied for the last several weeks now, so a little pullback is healthy for the next big push up. And I feel that if the markets can get a little bit of a pullback, we might even get into a full-fledged correction here. I think it's, again, way overdue, and here we're coming into a seasonal weakness slash choppy time of year, which that should take us all the way into September. And then again, we had that little bit of seasonal weakness September, October, and then again going into the holiday season, we get a real good push to the upside. So XLF, again, giving us a little bit of a sign here. Let's take a look at the weekly chart of the spiders, which is the ETF S&P 500 index. You can see the weekly chart since October of 2012, right after Sandy, has been intact and is absolutely in bullish mode. So there's really no problem here with the S&P on a weekly basis. On a daily basis, we're back into that ascending triangle. What am I looking for today? Usually, again, we have the candles here that we have this big, large engulfing red candle. We usually retrace 50% of that candle back up above that 20-day moving average. So let's see how this works. Let's see if we do get a big push up. Remember, we've been consolidating here for quite some time. You can see back from February, and if you pull back here, right at the beginning of November, we've really just consolidated here as well, aside from this little big rally that we had. So markets haven't really gone anywhere. And this is what I'm looking for, a little bit of consolidation. And really today, tomorrow, even Friday, really should be a deciding factor if we continue lower. Because if we retrace that candle on very low volume, 50% of that, right at 20, and then the next day, tomorrow, we fail and we start resuming our trend lower, then you're going to look for that lower trend line area of support here in that ascending triangle, okay? Now let's take a look at the IWMs. Now here's a Russell. Here's our secondary leader of the 4 indices that we follow, the 5 indices that we follow. And it has now started breaking down, putting that lower high from this previous high. That I don't like. This uptrend channel, this short-term uptrend channel has been violated, and we broke below the 20 and broke below the 50. So, again, if we have a little bit of move up, I would suspect we get back to the 20 somewhere around there, but we should fail just below that, making another lower high. That would confirm that we are indeed back in a downtrend mode, and we'll look for at least this area here at 121, and then, of course, the 200-day moving average as our next target. Okay, that's another red flag, something that I don't like. Transports, the biggest one of all. I've been stating this for the last several weeks. Watch out, watch out. Tighten up stops if you guys are swing trading or the longer-term investors. Do not buy any stocks at these areas. Why? Because we have the transportation sector, the IYT ETF, is violated its long-term uptrend, weekly trend line support from October of 2012. Okay, it has not violated that in quite some time. Actually broke here, but closed well above it. And now this is the second week in a row that we're below it. So to me, this is something of concern. If you are long this market, you need to either tighten stops or start reducing some of your long exposure. Big volume here on a weekly chart. That's confirming that we have some sellers. And look at the volume zones, guys. This is not a good sign here. This is a thin zone. So what happens is once we get in that thin zone, we usually, it's like a vacuum. It just takes price all the way down to the next area of support, which is just going to be above this 200-day moving average. We've got to be patient here, and we have to be alert because this can happen fast. Risk can happen really fast, risk off, and that's something that I want you guys to be aware of. Look at a daily chart of the transportation sector. Really ugly, ugly chart. Now, I get the fact that it's heavily involved in crude oil, and there's a lot of influence in that. And I understand the repricing, that crude oil took a hit, and so the transports will reprice. I get it. But nonetheless, you cannot deny price action here is lower. And I've also did some historical technical analysis on transportation sector. Once we see the transport start to move lower, when they move lower first, usually everything follows, and then we get into a pretty decent correction. I'm not saying that that can happen right now, meaning that we'd have to get back immediately, get back above that 200-day moving average, which is right here, right up in this area at 156. That's a long way, and that's something that is a major concern of mine. And I do think that if we are down in this area, again, a thin zone, we can easily flush way down to the 140-ish, low 140 area. Again, on higher volume, marking distribution days. Have to be careful, guys. You have to be careful here if you, again, holding positions. All right, and the diamonds are right up in this area here, probably looking at, let's put it to you this way. If we take this area out here, this 178 area, right in this area here, I think all bets are off for the Dow, and you're going to see the 200-day moving average. And that's pretty much it. That would solidify this down move is beginning, and that 200 is going to be the first target, okay?